So I generally talk about, stable and established stocks. That's what makes up my biggest investments for the most part. But today we're going to talk about some of the riskier stocks I own. So before we dive in, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get a message from my sponsor, The Motley Fool. It's the best way to support this work I'm doing on YouTube. Again, fool.com/Frankel. So let me go ahead and share my screen really quick. So like I said, most of my portfolio is in relatively stable companies, blue chip stocks, real estate investment trusts, index funds. I would call about 80% of my portfolio boring in that way. That they're not the growthy companies. They're dividend stocks. They're meant to just gradually compound over time. The other 20% is in what I would consider growth oriented stocks, not necessarily risky. In fact, most of them are not terribly risky, in my opinion. I'm talking about companies like Amazon, Block, Shopify. But I do have some smaller positions in more speculative stocks, and that's what we're going to talk about today. So, a lot of people have different opinions. Some people would call Shopify a very risky stock, but I consider these to be the five riskiest stocks I own. Number one, and these are all small positions for me, all of them are. Number one is Lemonade, ticker symbol LMND. I am a big fan of insurance companies. I have larger positions in companies like MetLife and Markel. I have a small position in Lemonade. They are a very cash-rich company. They're trying to disrupt the insurance business, which, if that was easy to do, would have happened already. Um, but they've done a great job of kind of innovating, especially on smaller insurance products like renters insurance, really just kind of streamlining claims processes, making it really easy to apply. And customer satisfaction has been great so far. They have a large market opportunity. And if they can figure out underwriting, and that's a big if for this company, it could end up being a pretty big win. Most of their market cap is in cash. You're essentially getting the business almost for nothing at this point. So it's one that I think the risk reward dynamics make sense, but with the word risk underlined in that phrase. Number two, and I don't think this is as risky as a lot of people do, is Upstart, ticker symbol UPST. So they have not done that well lately in the past few years because loan volume has really dried up. The interest rate environment has soared, consumer confidence has dropped, the era of free money is essentially over. Um, so they need higher loan volumes, plain and simple. They've been unprofitable. Um, they need lower interest rates to really, or higher consumer confidence to boost loan volume to a level where they can make a profit. They're getting closer. Um, they have big long-term opportunities that they've really pumped the brakes on in recent years because it doesn't make sense to invest in new verticals as much when you're losing money and when interest rates are high and when you aren't sure how successful they're going to be. But their whole business is developing a credit approval system that's more effective than the standards like FICO. Um, and if they can do that, there are tons of opportunities in the mortgage space, in home equity lines of credit, in auto lending, in business lending. And I mean, auto lending they've rolled out, but they're just really scratching the surface of. Um, so big opportunity there, but a lot of execution risk. So I would definitely put this in the top five risky companies that I own. Number three, and I've been told by a few people that I'm not allowed to talk about Nextdoor too much anymore because I've talked about it a lot. So I'll keep this short and sweet. Ticker symbol is KIND. They're a cash-rich company. Their founder recently returned as CEO. Watch my full video on Nextdoor I did about a week ago if you want my full take on the company. But they're in the early stages of monetization and are expecting to reach break even by the fourth quarter, but very small, unproven social networking company. And a lot of people say, well, just invest in Pinterest or Meta or something like that. But I still like this one. Number four, as much as I love Redfin, it definitely deserves a place on this list of risky companies. Ticker symbol is RDFN. Um, they are a real estate brokerage platform. They call themselves a real estate tech company, but at the end of the day, they are a brokerage platform. They are a mortgage. They have a mortgage company. They have a title insurance company. They have a rental platform which they acquired out of bankruptcy. It was Rent.com. Now it's just called Rent. They could be a big winner as mortgage rates start to fall. They've already kind of, their stock has responded in anticipation of lower rates, but it could be just the beginning. This company has a lot to gain, especially if they could reach profitability in a normal real estate market. So I am a big fan of Redfin at the current levels. And last but certainly not least, this is the biggest company on this list. Number 5 is Roblox, ticker symbol RBLX. $27 billion market cap, and they are the most unprofitable company in my portfolio, just in terms of the dollar volume that they're losing. But I think they really have massive momentum. They have a lot of opportunity. They're probably the most the closest thing to a true metaverse stock in the market right now. Um, they're known as kind of the gaming company for younger people, but I think there's a lot more to them than that. And as wearable technology really starts to evolve, it's still in the very early stages. I mean, Apple's is just starting to roll out, and once we start seeing mass adoption of that, I think this company has tons of potential from here. I wouldn't be surprised to see this be one of my better performers over the long term. I also wouldn't be surprised to see it be one of my biggest losers. So it definitely has a place on the riskier list, but I think from a risk reward standpoint, this could be a great way to get on the forefront of a very exciting technology trend. All right, as a bonus, I'm going to talk about probably the riskiest stock that's on my radar that I'm seriously considering buying right now, and that is QuantumScape. They are an electric vehicle battery technology company, and they are essentially a pre-revenue business. They're developing a solid-state battery technology that's supposedly superior in several ways to what currently exists in the market in terms of range and charging time, a bunch of different factors, weight. Um, you know, electric car batteries are very heavy. So higher energy density, fast charging capability. They're getting a lot closer to commercializing. They plan to start commercializing their batteries next year. Somewhat, we're probably a few years off from them making serious money, but the early results are the product is evolving pretty nicely. They're starting to ship prototypes of some of their batteries already. They have a lot of cash. They have $1 billion of cash on the balance sheet, almost no debt, and because of this capital light approach they're taking to developing their batteries, they have enough money to carry them through 2028 right now. So this is definitely a moonshot stock. I think at the current market cap, it makes a whole lot of sense for investors, but I'd love to know what you think about that one. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.